All right, so picture this. It's a totally normal trading day, and then, out of absolutely nowhere, the silver market just goes completely haywire. I mean, a price swing so fast and so violent, it vaporized fortunes in minutes, and it left everybody just staring at their screens asking one question: what on earth just happened? Today we're going to break down the anatomy of this wild event, which some people are calling a silver rug pull.
You know, this quote from our source material really sets the tone perfectly, doesn't it? It tells you right away that we're not just looking at some squiggly line on a chart, we are examining the evidence of what might just be a market crime scene.
And this is the weapon. This is the trading candle from that insane day. Now, the price didn't just climb up to that high of 83.71. According to the source, it pretty much teleported. 1 second it was trading normally, the next, bam, it's at a brand new peak, and then, well, then the floor just completely vanished.
And the scale of that collapse, it was just staggering. We're talking about a $9 swing from the high point to the low point in a single session. Now you have to understand, in the world of precious metals, that is a massive move. It's the kind of volatility that just wipes people out.
So this really brings us to the central mystery we're digging into today. Was this just the natural, messy end of a speculative rally? You know, a bubble just bursting under its own weight? Or, and this is what the source suggests, was this something much more deliberate? Was this a calculated attack designed for a very specific purpose?
To even begin to answer that, we really need to get into the mechanics. I mean, how is an event like this even possible? The argument is that this was a classic market manipulation tactic, something known as a stop hunt, and it relies on a couple of really key ingredients.
Okay, so the first ingredient is leverage. This is when traders use borrowed money to control a way bigger position than they could actually afford. It's a classic double-edged sword, right? It magnifies your wins, which feels great, but it also creates absolutely catastrophic losses, and that makes these traders incredibly vulnerable to any sharp drops in price.
And the second key ingredient is something called the stop-loss order. Now, this is supposed to be a safety net. A trader places an order that basically says, hey, if the price falls to this specific level, just sell my position for me automatically so I don't lose any more money. It's a sensible tool, but here's the catch. These orders are predictable, and if they're predictable, they can be weaponized.
So here's the playbook for how a stop hunt works. Step 1 is the bait. You let the price run up, usually in a low-volume market when not many people are trading, and that attracts all the excited leverage buyers. Step 2 is the trap. A huge player, a whale, slams the market with a massive sell order. Step 3, the trigger. That selling pressure pushes the price down right to where everybody has set their safety nets, their stop-loss orders. Step 4 is the cascade. Thousands of those automatic sell orders all trigger at once, creating this terrifying waterfall of selling. And finally, step 5, the profit. The people who started this whole thing just swoop in and buy everything back at the bottom from all the traders they just forced out of the market.
This whole process, it has a name. It's called rinsing the leverage. And yeah, it is a brutal, predatory move. But if you're a large institution, it's an incredibly effective way to shake out all the speculative weak hands before you get ready to take the market to the next level.
But how can we be so sure this was some kind of manufactured event and not just a real, honest-to-goodness crash? Well, the source points to one critical, smoking gun piece of evidence: the huge disconnect between the paper market and what was happening in the physical world.
You know, the contrast between these two markets tells the whole story. On one side, you have the paper market. That's the world of futures contracts, basically just digital promises to trade silver later. That's where the algorithms went wild and the price collapsed into a volatile casino. But on the other side, in the real world of actual physical coins and bars, the price held firm. Dealers did not drop their prices. In fact, some even raised them. They were treating physical silver like a stable store of value.
As the source puts it so well, the dip was a paper event, not a physical event. Think about it. If this were a true panic, a real crash, people would be lining up to sell their silver bars and coins. But that didn't happen. The selling was totally confined to the digital world, and it was driven by computer algorithms, not by a real change in supply and demand.
So, if the selling wasn't coming from people holding the actual metal, then who was buying and who was selling? Well, let's do what they always say and follow the money to see how the different players reacted during all this chaos.
What happened was a really clear transfer of wealth. You had the FOMO crowd who jumped in with leverage, bought near the top, and got totally liquidated at the bottom. The banks, according to the source, did the exact opposite. Meanwhile, the big industrial users, think about the Teslas and Samsungs of the world that actually need silver, they waited patiently and used the dip to buy their inventory on the cheap. And the physical holders? They just held on, completely unfazed by all the drama.
And here's another huge clue: gold. While silver was going completely nuts, gold, the adult in the room, so to speak, was incredibly stable, just sitting there near its all-time highs. Now that tells us the panic wasn't system-wide. It was an issue specific to the way the silver market is structured. Gold was like an anchor, suggesting the long-term trend for precious metals was still very much intact.
Okay, so after all of that chaos and all of that pain, what was the end result? Well, you might be surprised to hear this, but the argument from the source is that this violent rug pull was actually a healthy and totally necessary event for the silver market. It was a reset.
What it did was introduce something you could call a volatility tax. And this is the price that was paid almost exclusively by the traders who were using way too much leverage. They were the ones who paid for all the drama that day. But if you just owned the physical metal, you paid nothing. Your ounce was still an ounce.
I love this analogy from the source. Instead of seeing that $83 price spike as a failure, view it as a preview. It's like holding a beach ball underwater. For just a split second, the grip slipped, and we all got to see how high it desperately wants to shoot up. It revealed the immense underlying upward pressure in this market.
So here's the crucial takeaway. This event cleared the decks. It wiped out the gamblers. It got rid of all that excessive, dangerous leverage. And what that does is it creates a much stronger, much more stable foundation, making the market way more attractive to the big, long-term institutional investors who are just waiting on the sidelines for a safer entry point.
So what can you take away from all this? Well, the source offers a pretty solid survivor's checklist. First, audit your leverage. Be honest with yourself. If that price swing made you physically sick to your stomach, you are way too exposed. Second, that $75 level is now the key floor to watch. Third, you've got to learn to ignore the intraday noise. That choppy action is designed to shake you out. And finally, always remember that the true long-term signal is the monthly price close, not the chaos of one crazy day. Which leaves us with the ultimate question, doesn't it? Did that ugly shooting star candle on the chart mark the final, absolute top for silver's massive run? Or was it just a brutal, necessary stress test for the market before the real journey to new highs, maybe even to $100, truly gets underway? The answer to that is going to define the next chapter for this ancient metal.